Hi, I'm Daniel LeBeau, and welcome back to the Fourth Revolution Quarantine Edition. Today we're talking about the divergence between the NASDAQ and the broader market, and that reversal we've been seeing this past week, as well as a couple stocks that may have underperformed the broader market in the past months and may be an opportunity today. So this is the S&P 500 chart we're all very familiar with, and we've been trading in this range right around 3,000 to 3,200 level, and we really just can't break through this. We hit this in early June. What is this? This is 3230. We hit this in early June, and again earlier this week, and we just can't break through. I mean, we're falling off of that, going into earnings. People are pulling some risk off the table and getting ready for what is expected to be the worst earnings season we've seen in over a decade since the 2008 financial crisis. So here's the NASDAQ 100 compared to the S&P 500, and we've seen a huge divergence between these two indices, with tech driving the NASDAQ 100 to all-time highs continuously. But we've kind of seen a reversal in this trend over the last week. And this has to do with, like I said, investors adjusting for risk going into earnings season, pulling some of the profits off some of their most parabolic tech stocks as they've seen since the bottom in March. And we're seeing a over 4% deviation since the beginning of this week. And I mean, right now I'm trading QQQ puts to hedge some of my tech-heavy portfolio. It may not be a bad idea for you to do the same. I've been buying in. I bought it up here, sold down here. I've actually been doing pretty well with it, but it's all about checking these levels and making sure that you know when to sell, when to buy. And I'm holding a couple puts right now. I'm probably going to hold them through today as we hit this earnings season. And we have Netflix at the end of the day, and we've got a plethora of other earnings next week and the week after that to keep your eye on. So here's the VIX. The VIX has not been able to get below this 200-day moving average. We've been hitting it and bouncing right off of it. We're at 28 right now, and I expect, this is the volatility index if you're not familiar with the VIX. I expect this VIX to continue to stay buoyant through earnings season. I think we're going to see a spike in volatility as these companies start reporting their unfortunate earnings, is what is the expected thesis of this Q2 season here. So some of the companies I'm looking at, I am rotating a little bit out of the secular tech names and into some value names that haven't really broken out of their trading trend up until recently. So Johnson Controls is an example of that. And as you can see, we've kind of been in a trading rut for JCI over the last month or so, but we're finally breaking out. This past week, we've driven up over 10%, and this is catalyzed by Johnson Controls' leadership in HVAC systems. So some people are speculating that the reason that there's an uptick in cases in Southern America is because the HVAC systems aren't properly filtrating out the virus, and it's actually spreading the virus more quickly as people stay indoors more with hot weather. They're turning on their AC more, and it's pushing the virus around buildings, and it's actually spreading it more. So people are speculating that they're going to need new HVAC systems, new filtration systems, new controls, and Johnson Controls, being the leader in the field, is going to be the go-to manufacturer for that. So we could see a long-term uptick for this company. I'm holding the stock. I'm going to be holding it probably up until we hit mid 40s, and I think it's a great buy for you right now as it breaks out of its trading trend. And the uptick in new construction is also going to continue to catalyze this upside movement by JCI. So Weyerhaeuser is another company that's finally breaking out, a secular name. This company is one of the largest lumber stocks in the U.S. today, and lumber is on the rise. We've seen futures shoot up over 20% this week alone, and Weyerhaeuser is just finally catching up. It's underperformed its segment because of its dividend cut to free up some liquidity during these uncertain times, but the company is actually in a great position to continue driving growth on its top and bottom line through the second half of this year, and analysts are expecting this dividend to be reinstated later this year. So we're seeing an uptick in do-it-yourself projects during this quarantine, which was the primary catalyst of the original uptick in lumber, but we're continuing to see lumber drive further and further up as new construction projects are popping up left and right with these builders trying to take advantage of the hyper low interest rates we've been seeing, as the 30-year mortgage dropping below 3% for the first time in the history of the rate. So I think there's a huge upside here. I'm going to compare it to lumber futures, which it's actually been trading in line with for years. And all of a sudden, lumber's been spiking, and WY has been lagging behind. So I think this is an opportunity for us to get into the lumber surge after the lumber surge actually happened. I think there's a huge gap here between WY and the lumber futures, and it's going to be closing here shortly. Uber is the final stock I am talking about. This is a tech stock, but it hasn't broken out like its other tech cohorts. It just closed a deal with Postmates last week, and this deal is going to drive its grocery delivery segment as well as food delivery segment to new highs. So the company has already been able to turn a profit last year. It's an operational profit in its ride-sharing business, and now it's trying to do that with its food delivery service. And a lot of people were skeptical about its food delivery service, saying it was too competitive, too saturated. But right now, this industry is consolidating fast, and Uber is in a good position to take control of key markets. So look for Uber to turn a profit. They say they're going to be cash flow positive by next year, and continue to drive growth more and more. This company is only trading at a 3 times sales or price to sales, and this is unbelievably low considering its positioning in the tech industry and its unprecedented product offering that's never really been seen in history. So this company, I think, has a huge amount of upside potential, and I would take no precautions here and just buy it at its current price. 3 times price to sales is unbelievably low, with all of its other tech cohorts trading at huge double-digit valuations of price to sales. So I think it's a great opportunity today, and I would not hesitate to buy. So remember, guys, be cautious during this earnings season. It's going to be an exciting and uncertain one. Like I said, this could be one of the worst EPS seasons since the financial downfall of 2008. So be cautious. I would consider maybe pulling some profits on some of your most parabolic tech stocks and putting them to good use in some of the cyclical names like I discussed earlier. So don't forget to check out Zacks.com/promo for our latest promotion on Counter-Strike, which is our cohort Jeremy Mullen's portfolio. So thank you for watching, and look forward to speaking to you guys next time.